Hello, welcome viewers on Crypto Plus Wild News in Crypto. Uh, Macroeconomic data points toward intensifying of pain for crypto investor in 2023. In this news, we're sharing an important US topic. This is very exciting news. Undoubtedly, 2022 was one of the worst years of Bitcoin BTC buyers, primarily because the asset's price dropped by 65%. While there were some explicit reasons for the drop, such as the Luna USD crash in May and the FTX implosion in November, the most important reason was the US Federal Reserve policy of tapering and raising interest rates. Bitcoin price had dropped 50% from its peaks to loss of $33,100 before the Luna USD cash. Thanks to the Fed rate hikes, the first significant drop in Bitcoin's price was due to growing market uncertainty around potential rate hike rumors in November 2021. By January 2022, the stock market had already started showing cracks due to the increasing pressure of imminent tapering, which also negatively impact crypto prices. Um, Fast forward and the crypto market continues to face the same problem where the headwinds from the Fed rate hikes have restricted substantial bullish moves. The worst part is that this regime may last much longer than the market participants expects. The dot-com bubble of 1999-2000 called teach investors a lot about the current crypto winter, and it continues to painstaking picture for 2023. The tech-heavy Nasdaq composites inflated to enormous levels by the early 2000s, and this bubble burst when the Fed began raising interest rates in 1999 and 2000 as credit became more expensive. The amount of easy money shrunk in the market, causing the Nasdaq to drop from its peak by 77%. The crypto market is currently facing the same scenario. Fed Chairman Jerome Powell is hell-bent on curbing inflation, and this means there will behavior behind rates for some time ahead. Minneapolis Federal Reserve President Neil Kashkari wrote in a blog post recently that he expects the terminal rates to go up to 5.4% by June 2023. Currently, the rates are in the 4.25% to 4.50% range. Notably, at the time of the dot comparable, the Fed stopped increasing rates in May 2000, but the downturn in Nasdaq continued for the next 2 years. Thus, we can expect the crypto market to drop further at least until the Fed pivots. There are risks of the current bear market stretching even longer if the US economy experiences a recession similar to 2001. Increasing sign of recessions are according to a report by Macy's Institute analyst Ryan McMahon. The M2 money supply of the US dollar turned negative in November 2022 for the first time in 28 years. It is an indicator of potential recessions, which is usually preceded by slowing rates of money supply growth. While McMahon acknowledged the possibility of the negative money supply growth indicators running into a false signal, he added that it's generally a red flag for economic growth and employment. It also serves as just one more indicator that the cards of letting promised by the Federal Reserve is unlikely to ever be a reality. The latest report from the Institute of Supply Management also shows that US economic activity contracted for the second consecutive month in December. The purchasing manager index came out at 48.3% for December and to values below 50% significant contraction. It suggested that the demand of manufactured goods is displaying probably an impact of higher interest rates. The average US recession since 1857, latest 17 months with the six recessions since 1980, lasting less than 10 months. These recessions technically began in August 2022 with two quarters of negative GDP. Growth historical averages show that the current recessions may last until June 2023 to January 2024. The crypto market needs the realm of easy money to return to build a sustainable bull run. However, based on the first current plan, those conditions look for a way into the future. Only a Block 7 event that forces the US government to resort to quantitative easing will low interest rate economics stimulus like it did during the COVID-19 pandemic can ignite another bull run. According to independent market analytics, Benelli a bubble might be forming in the consumer loan sector, which has grown exponentially in the last decade to nearly $1 trillion. Thanks for watching. I hope you will like my video. Please do not forget to subscribe our channel Crypto Plus. See you soon in the next video. Thank you.